Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first Panama court voids CK Hutchison's canal contract, jeopardizing a $22.8 billion BlackRock deal and reshaping global trade routes. Today, we'll take a closer look at this legal bombshell and its implications for global supply chains and the US-China strategic rivalry. Second, Trump taps hawk Kevin Warsh for Fed chair, creating a policy paradox and threatening the central bank's political independence. So we'll discuss why this paradoxical appointment creates a battle for Fed independence and what it means for future interest rate policy. Third, India's 7.3% growth masks an economic paradox as foreign investment collapses and corporate India's 13-year investment strike continues. We'll analyse why this disconnect between headline growth and private investment matters now, and how it challenges India's China plus one narrative. The most unexpected news in the finance world today comes from the heart of global trade. Panama's Supreme Court has annulled contracts held by a Hong Kong-based firm to operate key ports on the Panama Canal, a vital artery that handles 5% of global maritime volume. So the thing is, the use of a domestic constitutional court ruling to void a commercially sensitive contract sets a new playbook for smaller nations navigating great power rivalry. It shows how they can use their own legal systems as a strategic tool, introducing significant legal uncertainty for long-term foreign direct investment and potentially reshaping how international contracts are arbitrated. The company, CK Hutchison, has operated 2 of the 5 ports since the 1990s. Now, its decades-long concession has been declared unconstitutional. This move echoes past claims by former US President Donald Trump, who once stated, "China is operating the Panama Canal. We're taking it back." While there is no public evidence of Chinese government control, Beijing's influence over Hong Kong has certainly changed how CK Hutchison is viewed on the world stage. This shift in perception has real financial consequences. What we're seeing is the erosion of Hong Kong's traditional status as a neutral commercial gateway. For a Chinese-speaking audience, this is particularly important because it means international investors are now pricing in a higher political risk premium for Hong Kong-listed companies with global operations. This could accelerate the reallocation of capital to rival financial hubs like Singapore, but that's not the whole picture. The real turning point is that the ruling throws a wrench into a colossal $22.8 billion deal. CK Hutchison was in the process of selling its global port interest to a consortium led by US investment firm BlackRock. That sale, once seen as a way to reduce political risk, is now in serious jeopardy. Interestingly enough, the collapse of this specific deal is a symptom of a much larger global trend. It's a textbook example of what economists call friendshoring. The idea is to strategically move control of critical infrastructure, like ports, away from geopolitical competitors and towards allied nations to enhance economic security. This extends the US-China competition beyond just technology and into the physical world of logistics. Recent data from the World Trade Organization confirms this, showing a significant increase in infrastructure projects being reallocated from Chinese linked to Western operators. The market reaction was swift and brutal. CK Hutchison shares plunged 4.6% in Hong Kong, dragging the entire Hang Seng Index down by more than 2%, a clear sign of that political risk premium turning into real-time losses for investors. This is where the situation takes a more complex turn. CK Hutchison's subsidiary fired back, claiming the ruling lacks legal basis and jeopardizes thousands of local jobs after it invested over $1.8 billion. But the most incendiary response came from Beijing. China's foreign ministry has now officially stated it will take all necessary measures to resolutely safeguard the legitimate rights and interests of Chinese companies. This ruling is far more than a contract dispute. With a Danish shipping firm now temporarily managing the sites, the decision upends a massive corporate deal and signals a major victory for Washington in the escalating strategic rivalry for control over the world's most critical trade choke points. This sudden operator change is a major test for supply chain resilience. The new temporary operator is reported to be a Danish firm, likely APM Terminals, which, according to a World Bank report, actually operates some of the most efficient container terminals in the world. However, any friction during this handover at the Balboa and Cristobal ports could still threaten to increase port congestion and shipping costs, especially for trade heading to the US East Coast. This is a key indicator to watch, especially since the Panama Canal Authority had recently reported a reduction in vessel wait times. Looking ahead, the fallout will be visible in a few key areas. First, keep an eye on the stock performance of other Hong Kong-based companies with significant overseas assets, as they may face similar reassessments of political risk. Second, watch for any data on port congestion or shipping delays out of Panama, as this will directly impact global trade costs. Finally, this event is a leading indicator of the friendshoring trend. Expect more policy announcements from Western countries aimed at securing their supply chains, which could benefit their domestic infrastructure and defence sectors while creating headwinds for some Chinese firms. This strategic shift could also lead to more volatility in currency and bond markets as capital reallocates globally. This information is for informational purposes only and does not constitute investment advice. Market conditions are volatile and subject to rapid change. We were just talking about the geopolitical risks shaking up global infrastructure. Now, let's shift to a political appointment in the US that's sending its own shockwaves through the financial world. Donald Trump, who has always described himself as a low interest rate guy, just announced his pick to lead the Federal Reserve. The choice? Kevin Warsh, a man who built his reputation as a supporter of higher interest rates. The situation presents a fascinating duality. A while back, we walked through the widening confrontation over Fed control, the Justice Department's probe into Jerome Powell, threats to fire him, even that Supreme Court case on whether a president can remove a sitting Fed governor and naming Warsh is the clearest escalation yet. In central banking, you have hawks who prioritize fighting inflation with higher rates and doves who prioritize job growth with lower ones. Warsh is a known hawk. Now, get this, there's another layer. Warsh has also been a vocal advocate for shrinking the Fed's massive balance sheet. This process, called quantitative tightening, involves the Fed selling off bonds, which naturally pushes long-term borrowing costs higher. This puts his stated policy preference in direct conflict with the president's desire for lower rates. The irony was lost on no one. Trump declared Warsh is central casting and will never let you down. But Wall Street remembers Warsh as a hawk who fretted about inflation during the 2008 crisis. Now, one congressman accuses him of showing a willingness to wildly alter his views based on who is in the White House. You see, this all centers on the concept of a central bank's reaction function. Think of it as a predictable formula, like the famous Taylor rule that guides how the Fed should react to economic data. For decades, markets have trusted the Fed to follow this economic logic, not political whims. As we warned a while back, once politics gets priced into policy, forward guidance turns fuzzy. If markets believe policy is no longer predictable, they might start to test the Fed, creating a credibility crisis that could unanchor inflation expectations and force a much more painful, sudden interest rate hike down the road to regain control. This all goes to the heart of a massive power struggle over the independence of the world's most powerful central bank. One economist who knows Warsh warns that if the Fed chairman simply takes directions, it would create tremendous turmoil in the financial markets. And here's where it gets interesting. The institution could push back from within. Powell's chair term is ending, but his governor term runs much longer. We've noted the precedent. Mariner Eccles stepped down as chair, yet stayed on the board and helped secure the 1951 Treasury Fed Accord. If Powell remains, he wouldn't be alone. Other governors have terms stretching into 2032 and 2036. That sets up the possibility of a real voting bloc that could resist a new Trump-appointed chair and even paralyze policymaking. We've already seen early cracks, remember. Last year marked the first time in decades. Two governors, Waller and Bowman, dissented in the same meeting. Critics are also questioning if the job is tied to the fact that Warsh's father-in-law is a Trump donor and friend. A strategist at Macquarie Group puts it bluntly, stating, Warsh is not the Fed's guy, he is Trump's guy. A few days ago, we also flagged how prediction markets were quantifying this political risk. Kalshi was pricing a high probability that Powell would be out entirely by late summer. Keep that in mind as a live gauge of market unease. This is significant because the implications go far beyond Wall Street. A politically influenced Fed could accelerate a trend that central banks around the world, including in China, are already watching closely: de-dollarization. After all, the US benefits from something called an exorbitant privilege because the dollar is the world's main reserve currency. This allows the US to borrow money more cheaply than anyone else. If other countries lose faith in the Fed's independence, they may speed up their diversification away from the US dollar to hedge against American policy volatility. Over time, this could weaken a key pillar of American economic power. Traders are already placing their bets. Immediately following the announcement, gold prices dropped and the dollar gained, a classic signal that investors believe Warsh will stick to his hawkish instincts, which could mean high borrowing costs. So that explains the market's initial reaction. Traders are betting that Warsh's deep-seated hawkish DNA will win out over any political pressure. This sets up the central conflict of his potential term. Will he prioritise shrinking the balance sheet and keeping inflation in check, as his history suggests, or will he pivot to the low-rate policy the president demands? The two are fundamentally at odds. And as we've discussed, if a block of incumbent governors digs in, that internal standoff could make policy signals even noisier. While supporters see Warsh as a responsible pick, the battle lines are drawn. The question isn't just about monetary policy, it's about whether the Fed will serve the wider economy or a political agenda. As the last Fed chair learned after his own appointment, presidential expectations and market realities can be two very different things. To understand how this might play out, the first focal point will be the Fed's balance sheet. Any acceleration in quantitative tightening or QT would signal that the hawk is in charge, likely pushing up long-term rates for things like mortgages. Second, listen for any talk of unwinding post-2008 financial regulations. A push for deregulation could boost bank stocks in the short term, but raises long-term questions about systemic risk. Finally, economists will be comparing the Fed's decisions against standard models, like the Taylor rule. Any major deviation could be a sign that politics, not economics, is driving the ship. One more thing. Watch the vote counts and dissents. If we start to see more governor-level dissent, that's a sign the internal block is active. And keep an eye on whether Powell stays on the board. If he does, it's an institutional defense move. For a real-time read, track prediction markets like Kalshi. Where their odds go now will tell you how seriously markets take this power struggle. As a reminder, financial markets are volatile and past performance is not indicative of future results. This report is for informational purposes only. Speaking of economic contradictions, let's head over to India, where the story is all about a major disconnect between massive growth and cratering investment. Let's start with a single statistic that might just change your entire perspective on India's economy. Net foreign direct investment has collapsed to just 0.1% of its GDP. For context, Asian economies that sustained rapid growth, like China and Vietnam, saw that figure surge above 4% during their boom phases. Now, net FDI is a lagging indicator, meaning it reflects past decisions. But believe it or not, its near zero level reveals a deep-seated issue. Many experts, like Ruchir Sharma of Rockefeller International, point to the lingering effects of the license Raj, a complex web of bureaucracy that, despite reforms, still creates a challenging environment for foreign investors. This lack of foreign capital not only limits funding, but also slows down crucial technology transfer and high-quality job creation. This is all happening while India is on track for world-beating 7.3% growth, a performance its central bank is calling a Goldilocks phase. But the headline numbers are masking a much deeper story. Consider the job market. India's 5 largest IT companies, which for decades created tens of thousands of white-collar jobs every quarter, added a net total of just 17 employees in the first 9 months of 2025. This hiring freeze in the sector that built the country's modern middle class is a telltale sign of severe labour market weakness. The force driving this shift is artificial intelligence. While hiring has stalled, the Indian tech sector's revenue is still growing strongly. This signals a massive leap in productivity. According to an EY report, AI is set to automate nearly a quarter of all tasks in the sector, and research shows over 40% of India's IT workforce is already using AI tools. This means the very engine of middle-class job growth is being fundamentally rewired, which could undermine long-term consumer confidence. If that was just the appetizer, the main course is just being served. According to a JP Morgan economist, private corporate investment has, quote, flatlined since 2012. He poses the direct question, how come for 13 straight years, corporate India has not invested? This investment strike, particularly from unlisted private companies, actually points to a chronic lack of domestic demand and low factory utilisation. Despite strong public spending, the private sector's share of new investment has actually fallen to a decade low. This questions the sustainability of a growth model that relies so heavily on the government's checkbook while the private sector sits on the sidelines. This investment freeze is compounded by external headwinds. India has entered 2026 under the looming shadow of Trump's 50% tariffs, a deadlock with the US that is dragging on exports far longer than expected. A while back, we talked about how this very pressure pushed New Delhi and Brussels to lean into friendshoring, fast-tracking talks to reroute trade toward trusted partners. While the Modi government has inked new trade deals with partners like the European Union, the damage is already showing. This new trade deal with the EU is more than just a countermeasure, it's a high-stakes test. We previously analysed the EU-India agreement as the flagship of friendshoring, and today the focus shifts to whether it can actually deliver. It's designed to prove India's credibility as a China plus one supply chain alternative. The agreement is set to boost trade to over $200 billion by 2030 and provide a massive leg up for India's textile and auto parts sectors. Remember, we also noted that textiles and garments had recently lost preferential tariff benefits in the EU. This deal would effectively snap that advantage back. Continuing that thread, there's a catch we flagged before. The EU's carbon border adjustment mechanism, essentially a carbon tax on imports, could add up to 22% in extra costs on products like steel and aluminum, blunting some of the FTA's gains. The success or failure of this pivot will be a major signpost for whether India can truly compete with manufacturing hubs like Vietnam for a bigger slice of the global trade pie. The government is spending more than $100 billion annually on new infrastructure to fuel the economy, but it's walking a fiscal tightrope. It's committed to this massive spending while also promising to reduce its overall budget deficit. Recent data shows the deficit is actually widening because of this infrastructure push, and any shortfall in tax revenue could force the government to pull back on this spending, which is the primary engine holding up that impressive headline growth number. But the data reveals a critical disconnect. With corporate investment stalled for over a decade and foreign capital all but vanishing, India's economic paradox is becoming its central challenge, sustaining world-beating growth when the engines of private investment and global confidence are sputtering. So, the key things to watch going forward are the private sector investment figures and capacity utilization rates. These will tell us if companies are finally starting to spend again. We also need to monitor India's export numbers to the EU to see if the new trade deal is working, and keep an eye on how CBAM-related costs hit key categories like metals. The divergence between high public spending and low private investment is a central tension in India's economy today, and how that gap is closed will determine its trajectory for years to come.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.